2023 has been a crazy ride for stocks so far. As of today, the S&P 500 has surged by an incredible 17.5%, while the tech-heavy Nasdaq has been soaring at a remarkable 41% year to date. But amidst all the market euphoria, there's a sector that hasn't been sharing the same level of success. Real estate. Standard & Poor's real estate fund, for example, has been pretty much flat this year. Today we'll look at some REITs that we might think are getting worth into your portfolio in August. But before that, I'd love to hear what REITs you currently have in your portfolio. Let me know in the comments, and if you're new here, on this channel, we make daily stock analysis videos on various companies, so make sure to subscribe if you don't want to miss any. The first company that we'll be talking about today is Kilroy Realty, stock ticker KRC. KRC focuses on acquiring, developing, and managing office properties in major US metropolitan areas. Their portfolio typically includes Class A office buildings, which are modern, high-quality properties that cater to the needs of businesses. Looking at the price action this year, it hasn't been looking very great. Although the stock has been rebounding, it is still down 5.4% year to date, which compared to major indices, the stock has underperformed quite a bit. And over the past 5 years, the stock is down almost 51%, and this compared to the S&P and the Nasdaq means they have once again underperformed significantly over the long run. This, however, might mean that there are opportunities to get into a position at an attractive price. Looking at the dividend summary, they currently offer a yield of 6.13%, which compared to other office REITs is on the lower side. But in return, you get a growth rate that is higher than most other peers with a 5-year growth rate of 4.5%. You would usually say that the dividend is very safe, seeing as the payout ratio is sitting at almost 49%, but for REITs there's a different metric that needs to be used. Instead of using the net income payout ratio, we must look at the payout ratio based on adjusted funds from operations. For KRC, this is sitting at a forward ratio of almost 63%, meaning that the dividend can be deemed safe. Looking at the dividend history, we can see that Kilroy regularly increases their dividend, but what is immediately noticeable is the dividend cut during the global financial crisis of 2008. During this, they had to cut their dividend by around 40%, but since 2016, they have started increasing it again, giving them 7 consecutive years of dividend growth. And their tenant portfolio is not looking too shabby either. With companies like Amazon, Microsoft, Salesforce, and Netflix being some of their tenants, we can say they have quite a solid tenant portfolio. If we perform a valuation with our REIT valuation model, we can see that with our various models like net asset value and discounted dividend, we get a fair value of $49.07, but that is not it yet. After this, we apply a margin of safety that is based on the financial health of the company. That for Kilroy, we have sitting at 15%. With this, we're left with a fair value of $42.67, which is under the current price of the stock, indicating that's currently undervalued by almost 18% based on our valuation. And by the way, if you want to see how I evaluate REITs, you can watch one of the stock analysis videos I've made recently on realty income that will be linked down below. And if you want to get your hands on this valuation spreadsheet that is used for all the REITs in this video, together with a bunch more other sheets, you can visit my Patreon, which is linked in the description as well. The second company that we'll be looking at today is Crown Castle, stock ticker CCI. Crown Castle specializes in owning, operating and leasing cell towers, fiber optic cables and other communication infrastructure across the United States. They provide critical infrastructure support to wireless carriers and other telecommunication companies to enable the expansion and improvement of wireless networks. 2023 has been a rough year for Crown Castle in terms of price action. The stock is down by over 24% year to date, and even in the long term, if you bought the company 5 years ago, you'd still be down almost 7%. Looking at that dividend summary, we can see that they currently have a dividend yield of almost 6%, which is a very generous yield compared to their peers. Even with a solid starting yield, Crown Castle has also increased their dividends by an average of 8.5% annually in the past 5 years. The dividend is relatively safe, seeing as their adjusted funds from operations payout ratio is sitting at just over 83%. This is, however, quite a bit higher than the other companies in this industry, so I wouldn't be surprised if they won't be able to keep up their current dividend growth rate. Since 2014, Crown Castle has been paying dividends, and these payments have been going on quite a bit over the past years, and with its dividend history, they have 8 consecutive years of dividend growth. If we look at their tenant portfolio, we can't say anything other than that it's looking very strong, with 75% of their revenue coming from strong companies like AT&T, Verizon, and T-Mobile. Crown Castle can assure itself that it will be able to maintain their cash flow generation from properties. Looking at our valuation spreadsheet, we get a fair value out of our models of $146.09, and once again we will applying a margin of safety, which for a Crown Castle we have sitting at 10%. Applying this margin of safety, we get a fair value of $132.81, which, with the current price of $104.93, gives them an upside of almost 27%. All the valuations we will be performing today will also be covered in separate video for each company, so if you want to get a more in-depth look into the valuations, keep an eye out on the channel for the upcoming period. The third company we'll talk about is CubeSmart, stock ticker CUBE. CubeSmart focuses on the acquisition, ownership, and management of self-storage facilities across the United States. They provide storage solutions to individuals and businesses, offering a variety of storage unit sizes to meet diverse customer needs. Unlike the other REITs that we have covered so far, CubeSmart is actually up year to date by almost 9.5%. This means they have outperformed the vast majority of REITs, but still underperformed indices like the S&P and the Nasdaq. In the long run, we see a similar performance. CubeSmart is up over 40% in the last 5 years, which is more stock appreciation than a lot of other REITs have seen over the years. As for dividends, CubeSmart is currently offering a solid yield of 4.59%, and in addition to this, the company has had very nice dividend increases with a 5-year growth rate of over 10%. Their dividend is looking pretty safe, as their AFFO payout ratio is sitting at 76.5%, which is only slightly higher than similar companies in the industry. Similar to KRC, CubeSmart also had to do a massive dividend cut during the 2008 financial crisis. Back then, they cut their dividend from 18 cents a quarter to just 3 cents. However, after this period, they started to increase their dividends again, and as of now, they have 12 consecutive years of dividend growth. Taking a look at our valuation spreadsheet, we get a fair value of $50.41 out of our models, and just like before, we have determined a margin of safety, which in this case is sitting at 0%, seeing as the financial health and growth of the company is very, very solid. This means that the average value out of the models is actually the fair value that we have determined, and this, with the current price of $43.04, means that the company is undervalued by 17.13% based on our analysis. The fourth company we'll be looking at is Agree Realty, stock ticker ADC. Agree Realty specializes in acquiring, developing, and managing retail properties throughout the United States. The company focuses on providing high-quality retail spaces to a diverse range of tenants. Their portfolio includes properties in various retail categories, catering to the needs of both national and regional retailers. So far this year, Agree is down by almost 9%, and over the long run, Agree has seen a price increase of just under 20%. It seems to be a recurring trend with REITs that they underperform the major indices, but keep in mind that we don't take dividends into account in this. And speaking of dividends, Agree offers a dividend yield of 4.62%, and similarly to companies like Realty Income and Stag, they pay monthly dividends. As for the growth rate, this is not looking too shabby either. Their 5-year average growth rate in their dividends has been sitting at 6.1%, and since they started paying monthly dividends, they increase their dividends every 6 months now. If we look at the dividend history, we can see that in 2021, Agree started to pay dividends monthly, and before that, we have also seen pretty nice dividend increases all across the board. Agree puts much pride into the fact that they have high amount of investment-grade tenants, and this is something not to sleep on. Their tenant portfolio consists of high-quality companies like Lowe's, Walmart, and Home Depot. With such tenants, you can sleep well at night without any worries. Once again, we've performed a valuation for this company. Out of the valuation models, Agree got a fair value of $87.62, but in this case, the margin of safety is higher than we have seen with other companies. Agree focuses a lot on growth, and due to this, we can see some of their margin and their rent reversion being sacrificed ever so slightly. Partially due to this, we're left with a margin of safety of 25%, and applying this margin of safety, we get a fair value of $70.10, which is almost 9% higher than the current price. The last company we'll talk about today is American Tower, stock ticker AMT. American Tower is the largest REIT that owns and operates communication infrastructure including cell towers and rooftop sites, and unlike Crown Castle, their presence is global. The company provides critical infrastructure support to wireless carriers and telecommunication companies, enabling them to expand and enhance their wireless networks. American Tower has seen a significant downturn in terms of price this year. The stock is down by almost 13.5% year to date, but in the long term it's actually up by around 23%. As for the dividends, AMT offers a lower starting yield than other companies such as Crown Castle, but in return you get an amazing dividend growth record, which in the last 5 years has been 16.42% average dividend growth rate, and we can't complain about the dividend safety either. Their current AFFO payout ratio is only 65.69%, which is quite a bit lower than the sector median. This means that there's plenty of room left to increase their dividends further. The tenant portfolio of American Tower is similar to the one of Crown Castle, where their main tenants are companies such as AT&T, Verizon, and T-Mobile, who are companies you can definitely rely on being your tenants. As per our valuation model, we get an average value for AMT of $236.25 per share, and applying our determined 15% margin of safety, we get a fair value of $205.43. This means that per our valuation, there is still almost an 11% upside left on this stock. And that wraps it up for this video. If you haven't seen my previous REIT stock analysis on realty income yet, you can click on the video right over here. And if you want to be notified whenever I upload, you can hit the subscribe button down below, and I'll see you on the next one. Thanks for watching.